Hey, welcome back to the channel. Keep bringing you deep dives into stocks like Opendoor Technologies. Now let's get into it, because today's action has been pretty interesting. We didn't exactly hit new 52-week highs, and we didn't break down into something catastrophic either. But the sentiment flipped negative almost instantly. It's always funny how quickly things can turn in the stock market. A small pullback after a huge run gets framed as if it's the end of the world, when in reality, the context shows something completely different. When we step back and actually look at the bigger picture, the data tells a different story. Over the last 5 trading days, the stock is still up about 20%. And if you zoom out even further, looking over the last 1-month period, Opendoor stock is up around 186%. That's a massive move in such a short time frame. So the fact that it's consolidating right now should not surprise anyone who's been around markets for a while. Consolidation after big moves is healthy price action. It allows momentum to reset, traders to take profits, and long-term investors to reassess their positions. But I get it. Psychology plays a huge role. When people don't see green candles every single day, they immediately panic and flip bearish. Today we had a low of 590, a high of 640, and trading volume of about 239 million shares. To put that into perspective, the average daily volume is about 308 million shares. So yes, today was below average in terms of raw activity, but it was still very elevated compared to many other names in the same sector. Importantly, there was no new fundamental news from Opendoor itself. No SEC filings, no major press releases, no official company announcements. That tells us the stock's moves were being driven primarily by broader market sentiment and technical trading, not necessarily anything specific the company did or didn't do. What did impact the market as a whole today was some economic data. The non-farm payroll annual revisions came in at 911,000. If that number had been closer to 200,000 or lower, markets probably would have shrugged it off or even taken it as a positive sign. But because it was such a big revision, it created uncertainty, and uncertainty always breeds volatility. Investors and traders started trying to reprice risk, which affected not just Opendoor but the overall market. These kinds of macro data points might not seem directly related to a company like Opendoor, but they do ripple through because they influence investor psychology and portfolio positioning. Let's pivot to shorts because this is where things get very interesting. By the end of the day, net short positions increased by about 2.3 million shares. That means roughly 23.43% of the free float is currently shorted. In total, about 155 million shares are being shorted. To give you some context, at the peak today, shorts had increased by around 14.8 million shares before trimming back. So while the net result was plus 2.3 million shares short, there was heavy activity intraday. This is very important because it shows shorts are extremely active and aggressive around these levels. And where are most of these transactions happening? On the dark pools. Hedge funds and institutions often prefer executing large trades there to avoid disrupting the market too much. But as retail traders, we need to pay attention to this because dark pool activity often foreshadows big moves. By looking at that flow, we can gauge whether hedge funds were really leaning into positions today or just lightly hedging. From what we saw, they were very active. Now here's something new that could really shake things up in the near future. Robinhood just announced that they're going to allow shorting on their platform. Think about what that means. Millions of retail traders who previously only had the ability to buy long positions or maybe buy options will now have the ability to short stocks directly. And if you've been paying attention to social media, you've already seen the chatter. Options data also gives us some useful clues. Today we saw about $24 million in calls traded compared to 8.7 million in puts. That means roughly 46% of all options activity was bullish in nature. Despite the volatility and despite the negativity you might be seeing online, there's still a strong undercurrent of optimism. Of course, some of those call purchases are shorts hedging their bets. If you're not familiar with hedging, here's a quick breakdown. Let's say a fund is short 1 million shares of Opendoor, but they're worried the stock could spike. To protect themselves, they buy out of the money call options at, for example, $6.50 or $7. If the stock rockets to $8 or $9, those calls will gain in value and offset their losses on the short position. It's a form of insurance. But the fact remains, call buying, even when it's hedging, contributes to bullish momentum. On the bull versus bear spectrum, what are people expecting? Bulls are targeting around $7 as their near-term consensus, while bears think the stock will drop below $5.50, maybe even down to the $5 range. So you have a pretty clear battleground here. Big buyers versus big sellers, each convinced they're right. That's what creates this kind of choppy, high-volume price action. Looking at secondary market transactions today, we saw some big blocks, including a notable $5.9 million trade. Throughout the day, there were pockets of heavy selling, followed by pockets of aggressive buying. That's exactly what creates the intraday volatility traders either love or hate, depending on their positions. The stock closed at $6.11, which puts it right between a key pivot point and support level. Specifically, $5.93 is the strong support, and $6.45 is the next resistance target. Interestingly, today's low was $5.90, right near that support, and today's high was $6.40, right near that resistance. It's almost like the stock is trading perfectly within technical boundaries. If we see a breakout above $6.45, it could signal a push towards $6.70 or even higher. Conversely, if it breaks below $5.90 with conviction, we could be looking at a retracement toward $5.40. These are levels to keep an eye on if you're actively trading this name. On social media, one of the trending discussions tying into Opendoor has been Robinhood itself, specifically CEO Vlad Tenev and his comments about shorting. Some people are trying to draw correlations between Robinhood's moves and Opendoor's volatility, even though there's no direct link. It just shows you how narratives form online, sometimes out of thin air, and how they influence retail sentiment. Aside from that chatter, there weren't any major news articles or research reports out today. Investors seem to be waiting for the next big catalyst. After hours, the stock did move up slightly, about 1.1%, putting it at $6.18. That might be an early indicator of some strength heading into tomorrow, though after-hours moves should always be taken with a grain of salt since liquidity is much lower. A single person with credibility and a loyal following can post a tweet, a video, or a meme, and suddenly the stock is off to the races. Eric, who's been one of the most visible supporters of Opendoor, has said similar things, that all it takes is one spark. The flip side, though, is that cult stocks without catalysts eventually stall. A company can only ride hype for so long before fundamentals have to kick in. At some point, Opendoor itself needs to step up and provide something tangible: earnings growth, new partnerships, product announcements, or strategic moves that justify the stock's valuation and momentum. And this brings us to an important point about investor relations. Eric, despite being a strong supporter, has started to express frustration on social media. He's been sharing messages from people complaining about Opendoor's customer service, saying things like, "Nobody answers calls, support is lacking, and the company isn't responsive." That's not good. For a company riding so much momentum, you would expect management to seize the moment, engage with investors, and improve customer perception. Instead, it feels like they're dragging their feet. If they want to capitalize on this wave of attention, they need to get serious about communication, service, and execution. Otherwise, they risk burning goodwill at exactly the wrong time. V.